elections handing the opposition a landslide victory, how soon are we going to see the policy easing measures opposition leader Shinzo Abe has promised? What can investors expect from the yen?
Well, Abe was talking about it, that he would really do something quite significant and quite soon. So, investors should be definitely ready that something in this direction is going to happen soon. And in any case, we don't really think that the yen is a big investment bargain opportunity. The currency isn't particularly cheap. Nor are Japanese bonds. The Japanese government bonds is one of the biggest bubbles that we see globally, particularly long-term ones, because the yield is already totally depressed, assuming that there's never going to be any sort of inflation. And so what's the upside potential there? We think there's a big risk to the downside in those bonds. Just as also in the United States, we are not keen on long-term treasuries, either long-term German, UK government bonds as well, by the way, though, because all of them have record low yields because investors have been scared of the markets. But we think they should be more scared of inflation going forwards, because all across the world in the major economies, they will have to massively increase the money printing policies simply in order to avoid the debt default, because all of those debt is uncontrollable. And so we think investors should get out of the yen, out of yen government bonds, avoid long-term fixed interest generally, and relatively speaking, we actually think that Japanese stocks may be a better bet than Japanese bonds, simply because stocks are more inflation-proof, and then if you're looking at book values, Japanese stocks aren't really that expensive, so we think they may be a bit of a better bet than the stocks in other major Western markets, although we still prefer Asia and some other emerging markets where you don't actually have any debt problem.
How should investors in Asia brace themselves for more liquidity in the markets?
Well, that's a good question. So more liquidity in the market, it's definitely also something that we think is going to happen going forwards from Japan on the one hand, but also from the US. Ben Bernanke just announced another round of quantitative easing. That didn't bring up markets short term, didn't bring up gold short term, because they're still talking about the fiscal cliff risk. But it doesn't matter what these fiscal cliff negotiations will come out to. In the end, the big problem in the US is not the fiscal cliff, but basically the debt and the fiscal gap, the total financial shortfall that the United States is facing. And so they have no choice but to print a lot more money if they are to avoid, or if they are to devalue the debt in real terms, and therefore get out of this debt trap that they may find themselves in, similar to a situation of Greece, where even the US, given the debt situation, they may possibly face a default on their debt if they don't massively print. And so liquidity is going to massively increase. So what should Asian investors do? Well, firstly, be aware inflation is most having the largest effect on people holding cash, on people holding bonds, especially long-term fixed interest. That's very vulnerable to inflation. So be aware of those inflation risks in cash and in bonds. On the other hand, gold, silver, commodities, they are a traditional hedge or safe haven from inflation. And also, very importantly, equities are also longer term more inflation proof traditionally than bonds or stocks, because equities do represent companies, and companies do have some sort of tangible assets behind them, whether it's commodities or their own factories, and they can put up prices in line with inflation for the goods and services they produce and sell to consumers, as long as the consumers can still buy it and their wages also rise. But so investors should be looking for hard assets, look for opportunities selectively in equity markets, maybe some property. All those things are more inflation proof than cash or bonds, albeit we say without leverage, not too aggressively in a diversified portfolio, because there's still massive risks out of the Eurozone and the US in particular. Those debt crises, they're far from over, and there can always be short-term shocks. So don't leverage, don't gamble. Even mortgages, ideally we recommend not to have any. And so if one can't buy property without a mortgage, maybe postpone it, or maybe sell some properties and deleverage just in order to be debt-free and safer.